Hey guys, my name is Divya. I'm a doctor and I've held a management role with a healthcare company for a while. Today's video is a highly requested video. People have been asking me all the time, were there formulas, were there calculations on the SHRM exam? So I've been wanting to do this video for a while. There's about a week left in this particular exam window in July 2022, so I really wanted to get this video in before the end of the exam window. I do hope that this video really helps you because it's really all about understanding the formulas in the business competency of the SHRM exam. There are only 10 financial ratios and formulas that SHRM wants you to know, and they're all here in this video. I've left a cheat sheet in the description box below. You can download the Word document, which means you will have all the formulas with you. There are also timestamps in the description box below, so if you want to just scroll through and click through the video, feel free to do so. Now, without any further ado, let's get right into the video. So here we go, guys, the SHRM financial ratios and formulas. There are about 10 formulas that we need to know, so let's begin. The first one is current ratio, current assets over current liabilities. So what are current assets? What's so current about them? The rule of thumb in business and finance is that anything that you can liquidate and get money out of is a current asset. So that would be cash in hand, that would be debtors who are going to pay you off in less than a year, things that you can liquidate pretty quickly. Current liabilities are liabilities that you have to pay off in less than a year. Again, this is just a rule of thumb. Less than a year is a rule of thumb in business and finance, and that's what you need to think of. We obviously want a higher liquidity ratio because it just means you have more money and more assets lying around. It's something that's preferred by creditors. Now, anytime you're having a tough time thinking about a ratio, think of numbers or things that you can plug into the current ratio or to any financial ratio. So here I have an example. If you have cash in hand worth $100,000 and creditors that you have to pay off in less than a year worth $50,000, what would be your current ratio? It's simple, right? The current ratio is going to be 2. So I don't think the SHRM exam is ever going to make you do these calculations. I've only done this for the purpose of explanation so that it's hammered into our brains and we know exactly what these ratios mean. That's what you really want. You want to understand the meaning of a financial ratio and what it represents in terms of the organization. For example, current ratio, higher current ratio means great liquidity, means great for the company and the organization. Financial ratio number 2, debt to asset ratio. Here we're not just doing current assets and liabilities, we're doing total liabilities and total assets. We want to know what's the ratio of total liabilities to total assets. If you have too much of a debt to asset ratio, then your liabilities are way too many. It's obviously bad for the organization. It means you have way too many debts and lesser assets. So it's not a favorable ratio if it's very high. The lower the debt to asset ratio, the better it is for the organization. Ratio number 3. What is the total debt to shareholders' equity ratio? So we want to know the equation between how much debt the organization has and how much equity, how much ownership do stakeholders have in the organization. A higher ratio can obviously mean that there's too much debt and it's a higher risk to shareholders. Number 4, one of my favorite ratios, accounts receivable ratio. It basically means whenever we're selling something on credit, how much are we getting back? So what are the net credit sales divided by average accounts receivable? How much are we receiving from the sales that were sold on credit? So we obviously want a slightly higher ratio here because it means that we're recovering our credit sales. But if we're having a very high accounts receivable ratio, it basically means that the organization has very tight credit policies. It basically means we're selling too much on cash and not letting our creditors have the time frame that they really need to pay us off for the sales. Ratio number 5, gross margin ratio. Really important in business and finance. We want to know what the gross profit is, guys. So we are going to take the total sales deduct the cost of goods sold and divide it by total sales. So what is cost of goods sold, right? It's your raw material, things that go in, the costs that go in to produce anything, to manufacture anything. If you were a t-shirt company, then obviously the material, the cloth are all the goods sold and the cost for it. So you're going to take the total sales, deduct cost of goods sold, and divide it by total sales. The higher the percentage, the higher the gross margin, the more the company retains on every dollar of sales. Next is the EBITDA ratio. You're going to hear your CPAs, the accountants, the finance folks in the company talk about EBITDA all the time. It's earnings before interest, tax, depreciation, and amortization, and we divide that by total sales. Think of this as just an earnings divided by revenue, and it's indicative of management performance. Ratio number 7, profit margin. Now everybody wants to know what the profit really is. We don't just want the gross profit, but the actual profit margin. So what are the total sales minus total costs divided by total sales? So basically, this is the profitability of the organization after all expenses have been deducted. So know the difference between gross profit and profit margin, and I think it's a good thing to know just as an HR professional, not just for the purposes of the exam. The next ratio is return on investment. So this might seem like a lot, guys, but honestly, this is something that we think of in our day-to-day lives. So we obviously think of in terms of an organizational return also. So whenever we're thinking of an investment, we want to know what the gain is from the investment. I stands for investment. What is the investment cost and what is the percentage? So this would be gain from investment minus the cost divided by the investment cost. So this would be a good thing for an organization to do when it's comparing costs and returns from different investment alternatives. The last two ratio, guys, earnings per share. What is the net income per share divided by number of outstanding shares? So this is frequently used by equity holders as an expression of their earnings, and it's really a simple thing if you can plug in numbers. So let's say you're earning $10,000 from the shares that you hold of a particular company, and you only hold 2 shares. So how much are you earning per share? You're earning $5,000 per share. That's really a good earning. Maybe you should buy more shares for the company. That's really all it means, and I think we shouldn't get confused by the expression in these particular formulas. The last ratio that SHRM wants you to know is the price to earnings ratio. What is the stock price per share divided by earnings per share? So this is really, if you're holding something, then what is the price that you're paying for that particular share and what are the earnings from that share? It's basically how much do you have to invest to receive $1 from that particular company. It also displays market confidence as to how much the organization can maintain or increase its earnings. So guys, that's everything that you need to know in terms of financial ratios and formulas for the exam. Once again, I hope that the videos are helping you. If they are, please take a moment to subscribe to my channel and give this video a thumbs up. Thank you so much for watching.